Good afternoon, RMIT University, Ho Chi Minh City campus. Are you ready for the presentation?
Good afternoon, panel of judges, ladies and gentlemen. We are RMIT University of Vietnam and we are ready.
Okay, good job. Okay, good luck with your presentation. And the presentation starts now.
Bridges, highways, television centers, and maybe your own apartments. These are seemingly very different constructions, but they all have one thing in common: steel. And in the steel industry of Vietnam, Hòa Phát is holding the #1 position. So today, we, RMIT University of Vietnam, issue a buy recommendation on HPG at 41,000 VND, presenting 26% upside potential. 80% of the company's revenue is for the steel segment, while the remaining 20% is for agriculture, real estate, and other industrial production. So why a buy on HPG? Not because the whole market is heading for it. Our belief is based on 3 key pillars. 1, it has robust revenue growth backed by strategic expansion. 2, it has superior margins from optimized cost structure. And 3, strong financial performance with healthy leverage. Let's start with the first point: robust revenue growth backed by strategic expansion. Hòa Phát Board of Directors has taken advantage of the cyclical nature of the steel industry for capacity expansion. Looking in the past, Hải Dương and Dung Quất complex were opened all during the trough of the steel industry, and then the company became the #1 producer in Vietnam. And this has driven the company's revenue to grow consistently over the past decade. Notably, it took the company 10 years to achieve such large-scale production, and it is the only one to be able to do so, given the capital-intensive nature of the steel industry. Heading to the future, Hòa Phát will focus on construction steel and the newly introduced hot roll coil through Dung Quất Phase 1 and Phase 2. And this will drive the steel segment's revenue to grow at a 17% CAGR in the next 5 years. But what will guarantee the consumption of such added volumes? For construction steel, it is the construction industry which will grow at 7% CAGR in the next 9 years, mainly driven by 1, accelerated government spending on infrastructure, and the bright outlook on real estate industry, given the rapid urbanization rate and growing house purchasing power. Hòa Phát will be able to capitalize on such favorable industry outlook, given the widespread distribution networks all over Vietnam and the highly competitive construction steel price, which allows it to capture even more market share. And another key driver is hot roll coil, which is a heavily undersupplied market, with Formosa as the only domestic supplier. So we believe that such huge unmet demand will allow the hot roll coil from Phase 2 and 3 of Hòa Phát Dung Quất to be fully consumed, given its competitive price outlook.
So, how can HPG implement such a competitive pricing strategy? It's thanks to the superior margins from the optimized cost structures. Firstly, while other competitors can only achieve this production chain, with the ability to produce in-house hot roll coil, HPG has become the first and only Vietnamese steelmakers with the fully integrated production chains. This has helped the company to reduce 5 to 6% of its production costs, as well as solidified its market leader position. Moreover, the ability to produce in-house hot roll coils come from the BOF technology that HPG currently deployed. This technology also helped HPG to save 10 to 15% of its production costs compared with the EAF technology that other competitors are using. And lastly, the strategic location of Dung Quất Steel Complex will enable HPG to enter into the central and southern market easier, as well as reduce 50% of its transportation costs. Ultimately, with the fully integrated value chain, BOF technology, as well as strategic location of Dung Quất Steel Complex, will enable HPG to capture the superior profit margins among its international and domestic peers.
And now, let's look at the financial performance of the company from 2 investment theses above. HPG also forecasted to have a strong revenue growth with 16% CAGR and best-in-class margins, which increase from 12 to 19% in the next 5 years. This will support the company's operating cash flow to grow at 27% CAGR. So Although the historical debt-to-equity ratio of the company is quite low, but the company knew how to use the leverage efficiently to expand new work, which caused the increase in debt-to-equity ratio from 0.3 to 0.7. But moving forward, we expect the company will repay its debt after the completion of new work and maintain a healthy leverage. Moreover, although the return on asset decreased during the past 3 years due to the construction of new work, but we believe a rebound in return on asset to 19% in the next 5 years when phase 2 fully operates. Ultimately, with improving profitability, return on assets, and healthy leverage, we confidently expect the return on equity to increase from 17% in 2019 to 28% in 2024 and maintain the ratio 2 times superior than its peer average, which also confirms the attractive value of HPG.
So from the above investment highlights, we have arrived at the 1-year target price for HPG at 41,000 VND, presenting 26% upside using sum of the part valuation. Specifically for the steel segment, the WACC is calculated at 13%, accounting for 4% of risk-free rate, and the terminal growth rate is computed at 1.8%, which comes from the long-term GDP growth of Asia Pacific and adjustment for steel consumption in this area. Then, for revenue growth, we break down this segment into 5 main product lines and make a forecast based on production capacity and utilization rate. And for cost of goods sold, this component is analyzed based on the input requirement for BOF and EAF technology and also movements in raw materials price. And with these figures, the free cash flow to firm model has generated an equity value for the steel segment at 36,000 VND per share, contributing to 87% of our HPG's target price. Regarding other segments, the relative valuation method is used, with the peers selected based on comparable business model, same revenue level, and profitability. Using relative PE to adjust for difference between markets, we have arrived at the target PE for agriculture and other industrial production at 7 times and 9.8 times respectively. And regarding real estate segment, our target PP is at 1.3 times, which has already accounted for the difference between return on equity of chosen peers. Ultimately, combining these 4 segments give us the base case for HPG. Moreover, we also run a scenario analysis with main assumptions about efficiency of government spending, recovery of the real estate industry, HPG's performance in the galvanized market, favorable movements of raw materials price, and also fluctuations in relative multiples. That said, our analysis reveals a bull case at 49,000 VND and bear case at 29,000 VND per share. And we also perform a sensitivity analysis for the WACC and terminal growth rate and for the price of iron ore and hard coking coal in the next 4 years, which further reinforces our buy recommendation and shows limited downside risk.
For the investment risk, we consider the 2 most significant are the raw material prices fluctuation and global trade protectionism. Firstly, the raw material prices fluctuation may cause uncertainty to HPG profitability. So the company has hedged this risk through taking derivatives contract. Secondly, the anti-dumping tariff from the US, Thailand, and Australia may hamper the international expansion of HPG. However, the company has diversified its export market to Asian countries to mitigate the risk. For the environmental and social, in fact, the BOF technology has generated more waste than the EAF, which negatively impact on the environment and the workers' health. To tackle these issues, HPG has invested in the circulation steelmaking process and provides safety training for staff. So we rank the environmental and social factor at 2.3 and 2.4 over 4 respectively. Regarding the governance pillar, HPG faces lack of independent member, only 1 out of 11. The internal member and the chairman-related members also hold up to 44% of total shares, which increase the risk of power bias. However, the properly audited transaction, the far-sighted board of directors with effective strategies, and the priority of shareholder best interest have proven the superior governance of HPG, confidently ranking at 3.8 over 4.
So with robust revenue growth backed by strategic expansion, superior margins from optimized cost structure, and strong financial performance with healthy leverage, we issue a buy recommendation on HPG at 41,000 VND, presenting 26% upside potential. So are you excited now? Let's steal this deal! Thank you so much for listening. And the floor
Thank
is
you,
open
the team, for
Q&A.
the excellent presentation.